What is up, you up to? Today we're talking about the difference between mutual funds and ETFs, what you should look out for as an investor, what these different types of funds do have to offer, what they are, what you should look out for, and as an investor, obviously what characteristics sticks out to you and what they require of you depending on your investment strategies. Now, before we get into today's video, please leave a like on the video and hit that subscribe button. It would mean the world to me. I mean, only 24% of you, as you can see here, are subscribed. I mean, that's insane. To think how far we would be with the subscriber count if more of y'all subscribe, it would be such a blessing. But nonetheless, let's get right into today's video. Okay, so an ETF, let's talk them real quick. So an ETF can be both actively or passively managed by some capital agency. So Charles Schwab has some ETFs, Vanguard has some ETFs. Many different investing platforms have their own ETFs, but they all represent a different sector. And sometimes they can be specifically for a certain index or a certain goal of performance. So some ETFs are dividend ETFs. So there's a Charles Schwab high interest, high yield dividend fund. Yes, that's right. And that is solely meant to be a high performer due to the dividends. And unlike mutual funds, this ETF is passively managed. So it's passively managed, meaning that you pretty much get a very select stock that has a very decent benefit structure for you, that you will get those high yield dividends, but it's not going to be consistently changing what stocks are going in and what stocks are coming out. It's pretty much going to be sticking pretty consistent. So you're not going to see massive changes in the performance of an ETF stock, because the stocks that are in that ETF is going to stick pretty much solely the same. It's going to be very much the same stock that you buy when you first buy in, and it's going to be this very same stock pretty much almost when you sell. But here's the thing, is you can buy ETFs that are actively managed, meaning they constantly swap in and out stocks and replace stocks. And if a stock is seen to possibly be a very bad performer in the future, they'll sell it. They'll put a stock that has very high potential. So they can take and pull and put in and take out whatever they want for some ETFs. So that's what it's really important when it comes to an ETF, is to do your research on it, see if it's actively or passively managed. Because depending on the management style on it will depend on what your investment strategy is. Because if you're wanting to get high investment yields and you're okay with taking a higher risk, then you want to take a more actively, more consistent investment into an ETF. But if you want just a very consistent growth and you know that nothing's going to change, so have a more conservative input and buying strategy in investing, then you want an ETF like the Charles Schwab high dividend ETF. And that's because you're going to get high yield back on your money. You're going to get a set percentage back because of the dividends, and you may even see some percentage growth because of the value of the ETF itself. So that's kind of what ETFs are really good for. But also ETFs, they don't usually require a minimum investment, but you do have to usually buy the ETFs in single shares. You have to buy them wholly. So if the Charles Schwab high yield dividend fund or high yield ETF is $100, you got to put $100 in to buy a share. And if you want to buy 2 shares, you got to put $200 in, but you're guaranteed that percentage that is promised to you by the ETF itself. So for that, it's pretty good. And really look at ETFs if you want to actively pursue and execute and track your orders and know what's going on, because sometimes when you buy an ETF, yes, although it's more of a passive investment scheme or passively thing, some sectors can take a major hit, and usually ETFs are based on a certain sector. So the Charles Schwab high yield dividend fund has a lot of oil industry and has a lot of medical industry. So if those two that die off, now petroleum, which is produced by the oil industries or the oil companies, is usually used in some medications in some form, some way, shape, or form. And so if the oil industry takes a hit, the medical industry is also going to take a hit. So this majority of the ETF that has that high yielding dividend fund is going to take an absolute plummet, and it's going to be really bad for you. So you need to stay actively attuned to what's going on in the market, what's going on and what's in your ETF before you buy it. So look into it. do your research and make sure like, okay, this is what I want to buy into. Because yes, usually ETFs are more passively managed, but that also means that they can't usually just be changed in and out if something is coming up on the horizon. Which means if you have I can't tell you if the Charles Schwab High Yield Dividend Fund, or High Yield ETF is actively managed or passive. I haven't looked into it. I haven't invested into it, but it's something you should look into. It's a great stock. It's a very high performing stock, but at the same time, I can't tell you if it's passively or actively managed. And that really depends on what the yield back is. Because if it is actively managed, that means if a sector of that ETF takes a hit, they can replace that and put in another stock that can still continue to grow the stock, the ETF itself in value, but then also give you that constant return that you're needing from the high yield dividend fund. So that's kind of why when you invest in an ETF, you need to stay in tune, stay aware, be alert with everything that's going on, what stocks are in it, and if it's actively or passively managed, because those are two very different things. So yes, ETFs, although on the front usually are passively managed, that means that you have to be actively managing it yourself. You need to be active in buying, selling, tracking, staying up with the news. You need to be active because the ETFs are usually passive. So do your research and do your due diligence in pursuing and what is going on with the ETF. Now, on the other hand, mutual funds come both in obviously active and passive, but usually mutual funds are very actively monitored and managed because mutual funds, the whole reason why mutual funds get the capital input and investment into the mutual fund or the corporation that holds the mutual fund is because the mutual fund goal is to outperform the market. The goal isn't just to see consistent growth and consistent returns like an ETF. Like with the high yield dividend fund, you're guaranteed that 8% of that dividend, which yes, it may build you 3% on top of inflation, but mutual funds, their goal is to outperform the market, and the market usually performs 7% on top of inflation. But the mutual fund, they're set out to beat that 7% on top of inflation. So usually they're trying to get 10, 15% gain on top of inflation. So meaning in total, they're trying to get about 19% growth each year. So mutual funds are very actively managed, very, very supervised. So because if the mutual fund falls out, the corporations that holding that mutual fund is going to lose value. It's going to lose investors. So mutual funds are very critical in the fact that they have the people that are doing the research and doing everything. You're not having to do that yourself. The management company that is holding is in fact being actively and managing it and staying aware of what's going on with the mutual funds so they can trade in and trade out stocks and just make sure that it can outperform the market, because that's the whole benefit of a mutual fund. So the other benefit of a mutual fund, and that could be a benefit to an ETF, is mutual funds you can buy consistently because you can buy fractional shares. So when you're buying a mutual fund, you can buy, each month $100, and if a certain mutual fund is $1,000, that means every single month you're buying a tenth of a share, and that means you can continually put money in. So as the mutual fund is seeing growth, you're seeing that same growth back. So if a mutual fund gets that goal of 19% growth, your money is also seeing a 19% growth. So 19% growth. So instead of your money just sitting there and being idle in the ETF, it's good because you can consistently put in money and see that growth over and over again. So mutual funds and ETFs can be very good investment strategies for long-term investments. But usually when people are buying mutual funds, they're consistently buying because it does allow for that individual investment. ETFs are usually bought, so ETFs and index funds, usually those are bought when it comes to retirement plans. It comes in when you have the money to buy whole shares, whole stocks, and to buy a lot of it at one time. So instead of seeing the needing and wanting the growth to happen of the 19% of what mutual funds try to get, you're seeing that consistent 8% return, because usually ETFs are just trying to stay with the market. So that's why sometimes they're passively and sometimes they're actively managed. So that's why ETFs are a good way once you get retirement to know that, okay, every year I have $5 million put into the stock, and each year I'm going to get 3% back on top of inflation. So that means that I can live off of that 3% and still have my money not be affected by inflation. But mutual funds are great in the fact that you can invest early. So you can start investing in mutual funds now. They can market in a recession. It's great to invest in mutual funds because mutual funds usually outperform the market. But when the market takes a massive hit just across the board, for example, in this recession, then all the stocks, ETFs, mutual funds are way down. And if you want to just put in $20 to get your foot into the door into investing, now would be a great time to buy mutual funds. And then you can see like, okay, it's not hard to get in partial shares. It's not hard to just start putting money into a mutual fund. ETFs, obviously, when it takes a hit, it's a great time to buy because you're going to get it on pennies on the dollar for a share. So that's why ETFs and mutual funds are usually pretty consistently invested in. It's because ETFs, you can almost guarantee a certain return rate depending on what makes up the ETF and what sector the ETF is based in. If it's a technology, if it's a oil, if it's a index fund, if it's a high yield dividend fund, if it's a high yield interest, if whatever the ETF is, you will see a pretty much almost guaranteed return. Now, yes, if the market takes a hit, your ETF will take a hit, it'll fall in price. But if it is a dividend, you're still going to be getting that money paid to you because you're a dividend investor. But mutual funds, they're very good to buy in the dips because when the market comes out of the recession and starts going up, mutual funds see massive growth. So you can see a huge compounding effect on your mutual fund and the investment you're putting in there. So all in all, ETFs are great if you want to be actively involved with tracking the stock, tracking the news. You can see really high returns in the short term with an ETF because they can spike up because a certain sector has a lot of activity like technologies or something. Or you can do mutual funds that you're consistently buying in and knowing that a certain fund, if it's managed by Charles Schwab, Vanguard, Fidelity, those funds are going to be actively managed by those investment sources, and that you can just constantly buy in and you'll see growth and have that compounding effect on your money. So in the short term, ETFs and mutual funds are great ways to long-term invest. So all in all, ETFs and mutual funds are a great way to just start investing, to have some diversification in your portfolio. ETFs can be spread across many different sectors, but at the same time, they can be sector-specific investment plans and ETFs. So it really just depends on what your investment strategy is, what you want to see in a stock. If you want to see a guaranteed rate of return, then get into a high-yield dividend fund. If you want to see a guaranteed amount of however much money you put in, get into an ETF that's a high-yield interest ETF. But if you want to see just a huge amount of growth on the money you're investing into it and the amount of shares you have, then buy a mutual fund. Mutual funds, ETFs are both great ways to invest long-term, as I already said, but they have different strategies and they have a major difference in the fact that ETFs very passively managed. So you need to be actively managing the ETF that you're buying into. You need to be aware of it. You need to have alerts on your phone. And because frankly, if a sector takes off, your ETF will take off, but then you got to sell because once it gets to the peak, it's going to pretty much fall back to the normal rate of return of that 4%. But that quick gain, you can have anywhere between 4 to 80% gain in that quick explosion from that ETF. So you got to stay aware with ETFs. Mutual funds is kind of like you're going down a lazy river. So those are the difference between an ETF and a mutual fund. They're both great strategies and they're both great ways just to look into it. If you want to start investing into an ETF or a mutual fund, go check out Charles Schwab. I have it linked down in the description, and set yourself up for an account. You can set up a Roth IRA with Charles Schwab. That way you can become a tax-free millionaire. Also, if you want to just invest in a ton of ETFs and just across the board, you can get a stock worth up to $1,000 with the link down in the description. So go ahead, go over to Public, hit that link, and they have a ton of ETFs across a ton of different trading platforms. And they have a very easy implementation of buying consistently into a stock market. They do have index funds and they do have mutual funds. So Charles Schwab and Public are great ways to start buying into mutual funds and ETFs and index funds. However, Charles Schwab does offer that Roth IRA so you can become a tax-free millionaire. Now, with that being said, this is the Money Sausage signing out. Don't forget to hit that subscribe button and the like button. See ya!